Ms. Amy Potter, the floor is yours.
Yes, thank you. And so this is for the Foothill Eastern term rate bond remarketing. And so just a real quick background here on these bonds. So here you see our complete Foothill Eastern debt structure of our interest and principal payments. And in 2013, when we refinanced the debt, we issued 3 subseries of term rate bonds at $125 million each. And the principal of those bonds matures out, you see in the late years there, 50 through 53. The first tranche was done in 2017. And essentially what a term rate bond is that even though the principal was set to mature out in the end of the debt structure, the interest was only set for a short term. So the first one was 5 years. The one that we're working with now is 7 years, and then there's one more tranche that would be at the 10-year point. And so the first date that we can call these bonds and reset that interest is July 15th, and it has to be done no later than January 15th. And so just like we had with the first tranche, we have an opportunity here with very low long-term interest rates to lock in those rates out to the final maturities. And by doing so, in addition to taking advantage of those lower rates and lowering our payments, we also eliminate interest risk in the future of interest rates rising when we go out to remarket them again, and also eliminating the associated costs that we incur each time that we remarket these bonds. And so what we're looking at here is that we have these bonds that were set at 5% for the initial term, and on the first tranche we were able to lock in a rate of 3.95% in 2017, and that saved us $1.3 million in interest every year all the way through the final maturity. With these bonds, if the market cooperates, we're looking at an interest rate between 3.5% and 4%. And so that would translate into an additional savings of $1.4 million in interest every year throughout the final maturity of these bonds. So as the director of the the chair of the finance committee had mentioned in his opening remarks earlier, the committee asked us to also look at paying off these bonds. And so as discussed earlier, really what we brought back to the committee is that we have this opportunity now to lock in a historically low interest rate on these bonds between 3.5% and 4%. And we have other bonds that are outstanding that are at a higher interest rate. And the next one that becomes callable would be the third subseries of these bonds that are currently at 5.5%. Those become callable in July of 2022. And then we have bonds that are at an even higher rate that range between 5 and 6.5% that become callable in January of 2024. And so to answer your question, Director Maryott, what we were talking about earlier is the difference, so the gross interest, the difference between a 6% interest rate and a 3.75% interest rate over that 34-year period. I can back it off a couple years. I noticed when you brought up the question, which would bring it down to about $90 million, but that's gross interest. So what I'm showing here on the screen is the present value calculation, and the present value calculation that we did was on $25 million. So I could roughly times that by 5 for $125 million, which was our comparison, and showing a present value savings that you see there accordingly. So the committee came to the conclusion that since the long-term borrowing rates are at near all-time lows, and whereas the shorter rates, which we invest our cash at, are somewhat higher than average, it's better for us to hold on to our cash and use them towards these more expensive bonds that we have that will become callable in the next 3 to 5 years. So with that, we've already been working on this process, and you have draft documents in your package today. So we've already had some briefings. We provided you with the draft documents. We are working with the rating agencies right now. We will continue to work with them. And then assuming that the market stays as good as it is today, we would expect to price these bonds on July 17th and close the transaction on July 18th. And so before you today, we have the documents in the package, but also a contract amendment with PFM for $75,000. But what I'm showing you here are all of those, the dollars essentially that go into the remarketing of these bonds. And so we already have an agreement with the bankers who are the remarketing agents, and we're estimating that those fees are $670,000. Bond counsel and disclosure counsel of $120,000, our general counsel of $20,000, rating agency fees of approximately $30,000, and trustee fees of $7,000. And all of these funds were in the budget that you approved earlier today. And so with that, and there is one thing I would like to mention with regard to the documents. So we did receive a call yesterday from OCTA asking us to add some language to the document, and the section that they were referring to is the capital section of the remarketing disclosure statement, essentially. And what that section is intended to do is give potential investors an understanding of projects that we're working on and additional bonds that we may issue and or using of our unrestricted cash. And so I think it's better when we're disclosing that to be more conservative, meaning that we included what we think is probably the earliest date for the 24191 project in there, because that's more conservative to let them know that we could potentially issue debt or use cash at that earlier date. What we agreed to do in our discussion with OCTA is just add some language that we are coordinating with OCTA and RCTC on an operating agreement, and with Caltrans and those other agencies just on the process itself. And so with that before you today, the recommendation is to approve the resolution that allows us basically to issue these bonds and the documents, and also to authorize the CEO to execute a contract amendment with Public Financial Management, our financial advisor, in the amount of $75,000. I'd be happy to take any questions.
Thank you very much for your comprehensive report. Discussions now.
I'll move the item.
Oh,
Okay.
oh, you wanted
I
to
was just going to move the item.
discussions?
Comment, question?
Please.
All of the above. Thank you for the presentation. So a couple of clarifying things, because I think part of the problem, and I really think it's important that we think about this in setting future agendas. I feel like, and I wasn't in the subcommittee meeting, but I think we're putting dollars and cents before our philosophy about debt. So we're looking at a refi opportunity to evaluate the debt picture instead of looking at the big picture, debt picture, and trying to figure out our philosophy about what kind of debt we should be carrying. So when you look at something like this, it sounds good to say we can save on interest, but just to clarify, we got $125 million in cash that we could use to pay off this tranche shortly. All else being equal, that's fully callable. We could retire that issue, right? If we remarket it, we have all the flexibility in the world in terms of the debt we replace it with, correct?
Correct.
Okay. So that's the same with the other two tranches as well.
Well, yes, correct.
Okay. So over the next, if we wait out the second issue, 2 years, 3 years, and we're picking up about 80 to 125 basis points return on our cash, we start behind the 8 ball by $8 or $9 million, a negative delta, if you will. Then we get to 2023. The risk is we don't know the interest rate environment. That's your delta. The present value back from the end of the second tranche is insulting, unless I'm missing something. We go into that decision, the immediate decision to retire the first tranche versus the next tranche. The immediate negative is about a $9 million negative trade-off versus cash that we're earning on our cash. versus debt. The difference between paying the debt and relieving the cash and investing in the cash. So that $9-10 million risk is an interest rate revenue risk in terms of paying off the second tranche. And we just go into the marketplace and buy a hedge on that. And this is the danger of putting a dollars and cents discussion before a big picture philosophy discussion about the debt of an agency or any entity and what our approach to it should be. How compelling is it? What decisions should we make about debt versus cash on the books when we look ahead as an agency? By putting a refi opportunity on the front end as a conversation starter to the bigger debt question is asked backwards. And this, I mean, and then this notion and to ask the board to accept those figures is ask them to be naive around fiscal matters, with all due respect. Because whether we retire this tranche or the next tranche, the only difference is, assuming our balance sheet looks about the same to the street, the only difference is the interest rate risk. That's the only difference. And we start behind the 8 ball, 9 or 10 million bucks. Because instead of paying, 3 months from now, instead of paying interest on the debt, we're collecting a few bucks. Instead of not paying, being relieved of the interest on the debt, we're picking up a few bucks on investment return. So I think what we really need is a full board meeting about how much debt we carry as an agency. What am I missing?
So the analysis, and we provided further details to the committee, of course. But the analysis, so first of all, let's look big picture of where the market is today. Long-term rates are very low historically. Short-term rates are higher than average. So we're comparing what
I'm
we
aware of that.
right?
They're also lower than the last time we refinanced, and we had this exact same conversation.
So now the comparison, though, in that, and the question that was asked is, should we use some of the cash, which is, yes, it's earning less than what we would be paying on the
By about
bonds.
3%.
Okay?
2.5 to 3.
So since we're earning a little bit better than normal on the short-term funds, and we can lock in now till final maturity.
I'm sorry, we're earning a little bit better than normal. We're earning historically less than normal.
We currently rates are a little bit higher than they've been over this last several years. Let's put it that way. So if we can lock in now an interest rate that is very low, knowing that we have bonds that are already outstanding at higher amounts, but they're not currently callable. So that was the analysis. The analysis was on looking at what's the better use of your cash. Is it using it towards paying off something that right now we can capture in the market and lock in all the way to the final maturity at a very low rate, or waiting a few years and paying off? So that's where I'm not understanding the interest rate risk on the future, because if the board so chooses to use the cash at that point in, say, in 5 years,
But
if you want to take the 6%.
The next tranche is fully callable. The next tranche is fully callable. All
Sure.
3 tranches are the same. So it's a $10 million versus interest rate risk, no matter how you look at it.
So let's use the example, which I think was a more compelling one in my opinion, of the other current interest bonds out there. These are not term rate bonds. They will just sit there and mature off as they're scheduled to mature off, and they're earning as much as they're paying as much as 6%. So what we're saying, and what the committee agreed
They're
with,
not callable.
they are callable in 2024.
The second tranche.
No, this is not the second tranche. This is other current interest bonds. These are
Okay.
2013 A's. So we have our full debt, the whole structure that we're talking about here.
Anything fully callable can be called.
And it won't be callable until 2024. And at that point, we should reserve and hold our cash to do that, because that's more expensive bonds than.
What is that? What you call it, it's gone.
Exactly. We're going to use the cash to pay off debt that's at a higher rate than what we
But
can
if you've
lock
got
in
the
today.
same balance sheet, you just reissue it. It's callable. It's $100,000 to flip it in the market. It's a $10 million equation versus interest rate. That's all it is. And to ask people to evaluate it in the context of longer term interest rates is fiscally irresponsible. I'm sorry. It's not all you're doing, you're reissuing $125 million in debt if we don't use cash to pay this next tranche. You reissue that same $125 million in 3 years. You just have interest rates.
No, I don't. This is locking in the interest all the way to the end.
It's going to be on any issue you do. We have to take it one off. I have to vote against it, and we'll take it one off. You're.
I mean,
I agree. Let's take this offline, and I don't respect calling my staff irresponsible. I'm very irritated by
I
that.
said the example. I didn't call her irresponsible.
You
The
implied
example was
that.
irresponsible.
So I agree. Let's take this offline. PFM is here. You guys can meet after this meeting, but this was not
dear,
going
I
the right
apologize if you
way.
took it that way. I didn't mean
And
to-
Director Maryott, with all due respect, my great friend, the mayor of city of San Joaquin.